Hello and welcome to my next video in my general accounting series called Financial Statements. Let's jump right in here with income statements. First, an income statement describes what a company's revenues look like and what a company's expenses look like. Now, a real quick thing about financial statements. The important thing about financial statements are that they show a comparison. Now, whether that comparison is from year to year, month to month, quarter to quarter, doesn't matter. Basically, it shows that you've either improved over a period of time or you've not improved over a period of time. You've stagnated, or worst case scenario, you've actually lost ground. Now, all statements, all financial statements, and most importantly, income statements, really tie into the full disclosure period and the time period assumption. If you're not fully disclosing all your information or fully presenting all the information that you have for either if it's the month, a quarter of a year, or a year, you have to present your information reliably and you have to make sure it's relevant. That is how it ties into the disclosure principle. Next is the time period assumption. You have to make sure that your information is not only up to date, but it's also has enough time has passed between each statement to make the information relevant and important enough for your investors to look over it. A really cool thing about income statements is that they show net income, or if you've lost money, net loss. Now, how do we get net income? It's total revenue minus total expenses. Now, total expenses, if they're greater than total revenue, then you have something called a net loss. Now, this is where income statements are vitally important, okay? Because they show all of your expenses and all of your revenues. So if you were looking at it from a management perspective, you could see which areas your revenues could improve or which areas you could cut expenses, which is why income statements are so important and so closely looked at by everyone in the financial sector. Another important part about income statements is that they are always the first statement to be prepared by any company. Now, this is an example, a really sparse example of what an income statement looks like. First, you're going to notice at the top is where your company names go. So you could be Ford, GM, Apple, doesn't matter. The name always goes at the top. Next, you're going to see for month ended, and then you're going to have the name of month and then the day of month. Now, the day of month is almost always the last day of the month. But it could really be any day of the month, depending on when you wanted to issue your financial statement. But you're always going to have for month ended, and then say it was in December, say it was in March, doesn't matter. That's the name of the month. Now, some of you are going to be saying, well, what if you only issue a yearly financial statement? Wouldn't it make more sense to say for year ended 2015 or for year ended 2017? Doesn't matter. You're always going to say for month ended and then say December 31st. And granted, you could add in, if you wanted to be more specific, you could add in the year, but it doesn't really matter. Investors are going to be looking at it if you're issuing your financial statement in a timely fashion. They're going to know what you mean and what year you mean. Now, next, you always start with revenues. You never want to start with expenses. That doesn't make sense because you're subtracting expenses from revenues, right? So you want to put your revenues first, since that's the first number you always look at. Now, you're going to see on the far left how each one is kind of separated. First, I have revenues that's not indented, and if you look across the revenues line, the first top line, you're going to see that there's no numbers in the right-hand boxes. That's because revenues is just telling my investors and management that is what I'm starting with. Next, you're going to see an indented version, an indented line. And now I'm going to say for here, this company just has consulting fees. Now, every revenue, it doesn't matter if it's consulting fees or rent or income or other incomes, doesn't matter. All revenues are going to be indented after the revenue line. Next, you're going to have total revenue. Now, total revenue is going to basically tell everybody what all your revenues add up to. Now, the consulting fees, if we look right here, they're one box left of total revenue. So if you added up all your revenues, all your added up revenues are going to be in the left-hand box, the farthest left, and then next is total revenue. That's going to be on the far right-hand boxes. Basically, the more left something is, the less information it provides, the less generalized the information is, the more left it is. Now, the more right it is, where the money is, where the dollar sign is, the more generalized it is. And you can see that is consulting fees are more specific than just total revenues, right? I hope that makes sense. So maybe it'll make more sense on the expense side. You can see how it's expenses, then rent, salaries, telephone, miscellaneous, and you can see how they are all more left than total expenses. Well, because total expenses is just all your expenses, where you can see miscellaneous expenses much more specific than just total expense. Now, after we get our total revenue, which is $14,000, and our total expenses, which is $11,890, we get our net income, which is $2,110. Now, with all financial statements, this is the case. The more general the information, the more general the monetary information, the more right, the farther right it is on the financial statement. The more general the information, the more specific, the more specific the information, the farther left it is. For instance, right here in this miscellaneous category in expenses, if the company wanted, they could split that up under, be like, okay, here's petty cash fund, we had to pay a postage stamp fee, etc., and all that would be counted under miscellaneous expense. But I didn't want to put in the time and effort to do that, so I just put it as all miscellaneous. Now, moving on to the retained earnings statement. This shows changes in equity. Now, if you remember from previous videos, equity is what the company controls, company-controlled assets. All right, and equity is also shown as common stock, revenues, expenses, and dividends. These result, so basically the change in equity results in either the added in from net income or subtract net loss. So you also have to show dividends change. So basically a retained earnings statement is going to look like this. You're going to first have the previous time period's retained earnings. So say your company's been in business for years. Like say you're a company like Ford. You've been in business since the 1940s. You're going to have a retained earnings statement from the previous years. And that's going to be all the money that you've kept in the business since you've been operating. And that's going to be your starting point for how you obtain your retained earnings statement. The next, you're going to add in your net income for this statement. So going on with the example of Ford. Ford has their previous time period, so like their old retained earnings statement, plus their net income if they've sold, if they've had more revenues and expenses for this month. And then Ford also pays out a dividend, so you're going to subtract your dividends from your retained earnings and net income. And that is going to get you your retained earnings. Now, this is another example of what a retained earning is going to look like. And you're going to notice it's the name of your company again, plus 4 month ended, name of month, day of month. And now you're going to see here previous month's retained earnings. And for this company, it just happens to be $0 because say your company just started, or say you paid out all your retained earnings as dividends. That's how you can get retained earnings as 0. Next, if you remember, our net income for our financial statement, our income statement, was $2,110. So that gives us a total of 2,110 for our retained earnings plus net income. And then we're going to subtract dividends, which they decided to pay 2,000 in dividends. So that leaves us with the total amount of money retained in the business, the total amount of money that is kept within the business after we add in our net income and subtract our dividends, is $110. This is going to lead us into the next financial statement called the balance sheet. The balance sheet basically shows a company's total financial position. And remember that the balance sheet, as in its name, basically shows the accounting equation. And the accounting equation always has to be balanced, which is why, hence the balance sheet. And it shows the monetary holdings of all your assets, so your land, your buildings, your cash, your accounts receivable, etc. Then all your liabilities and all your equities. Basically has to show that all your assets added up together equal all your liabilities plus all your equities. Now this is a quick example of a balance sheet. You're going to notice the same company name plus for month ended, yada, yada, yada. On one side of the balance sheet, you're going to have all of your assets, and you can see there your cash, accounts receivable, land, office supplies, etc. Adds up to a total of $92,610. Then we're going to get into our total liabilities. And I messed up there. You're going to see it's accounts receivable. I meant to put it as accounts payable. All right. Then we get into our common stock, which this company's just happened to be 84,000. And then you notice our retained earnings statement. Now, if you wanted to expand on that, you could say for your equity statement, you could show your revenues, then your expenses, then your dividends. But one of the cool things about having previous financial statements like your income statement and your retained earnings statement is each of these statements build on each other, right? So, for instance, by using the net income that you get from your income statement, you're able to get your retained earnings statement, which you get by having your previous month's retained earnings plus your net income minus your dividends. Now, as you notice, retained earnings really kind of fall under all the equity part of the equation that's not common stock, which is why we're so easily able to get our total amount of equities by just doing these financial statements. Now, as you can see here, if all my math is correct, which I'm 100% sure it is, we have our total assets equal 92,610, and that equals our total liabilities plus our total equities, which also equals 92,610. Now, I know I kind of went through all these financial statements fairly quickly, but I'm going to be posting example videos that will really help all of us kind of look at greater detail each of these financial statements. Thank you all very much for watching. Please leave a like and a comment down below. If there's a financial statement that you did not understand, you can either direct message me or, like I said, leave a comment and I can post another video on that. Thank you all very much, and talk to you all later.